Friends, I am going to discuss two editorial articles in the Hindu. One appeared on August 1, 2022, which titled PMLA Verdict and Erosion of Constitutional Buffers. And today, another article regarding to it has appeared, that is PMLA Verdict, a bulldozer effect on the due process. Both are written by practicing advocates in the Supreme Court. The PMLA verdict, the Prevention of Money Laundering Act, in the Vijay Madanlal Chowdhury's case has been discussed. In the first article, which appeared on August 1, which is titled PMLA Verdict and Erosion of Constitutional Buffers, a case related to Nigesh Tarachand Shah versus Union of India has also been discussed. The present thought-provoking process, which relates to the Prevention of Money Laundering Act, relates to the constitutional validity of the provisions in the draconian provisions in the Prevention of Money Laundering Act has been upheld by the Apex Court in the recent judgment on Vijay Madanlal Chowdhury versus Union of India. The Apex Court has held that, rather it chose to held that, the Section 45 of the Prevention of Money Laundering Act would prevail and very much constitutional. When analyzing the Section 45 of the Prevention of Money Laundering Act, it can be seen that there is an earlier judgment related to the Prevention of Money Laundering Act, which had been delivered in the Supreme Court case on Nigesh Tarachand Shah versus of Union of India. In Nigesh Tarachand Shah versus Union of India, the Supreme Court held that the two bifurcations of the bail conditions, that is, the two bifurcations of the bail conditions had been the accused under the Prevention of Money Laundering Act could be divided into two. One is the severe offense for which the 2018 law had given that an accused over 3 years of imprisonment could be granted bail only when the prosecution is satisfied with regard to the bail conditions and there was reasonable ground for believing that the accused would not commit the crime again. Supreme Court had held that it was unconstitutional. The bifurcation of two conditions, that is, one condition related to the 3 years and above imprisonment accused would be granted bail only on reasonable grounds being cited, was held to be unconstitutional. Later on, the government of India reintroduced such provisions, coloring it as a very new law on this aspect by way of Section 45 of the Prevention of Money Laundering Act. Under Section 45 of the Prevention of Money Laundering Act, the accused could be granted bail on the condition that the prosecution is satisfied that he has reasonable grounds for granting bail. A hearing would be conducted before the prosecution and at the bail stage itself, the accused has to prove that he was not guilty. The reasonable grounds included the belief that the accused would not commit the offense again. Here, in this Prevention of Money Laundering Act, there is a predating event, that is predating crime. The predating crime is the base crime, that is the root crime on which the Prevention of Money Laundering Act would be applicable to for the accused. What is Prevention of Money Laundering Act? The Prevention of Money Laundering Act seeks to prevent the money laundering activities by any person who is trying to make the black money with him the white. If he has committed an offense, the scheduled offense means the schedule under the Prevention of Money Laundering Act states certain scheduled acts. IPC one such act, the Copyrights Act is another such act, then Immoral Activities Prevention Act is one such act. So, the accused who has gathered money by committing any of the offenses under the IPC and the said acts, which are scheduled acts, the money, if is representing as untainted money, that is white money, he has laundered or whitewashed this money into white money from the proceeds of the crime and claiming it as very genuine money. Friends, the next article I'm going to deal with is macro variable projections in uncertain times. We have seen that the US Federal Reserve has raised the interest rates by 0.75 percentage. The Reserve Bank of India has followed suit by raising the repo rates. It is going on increasing the repo rates. The Monetary Policy Committee of the Reserve Bank of India is going on increasing the repo rates. It is in response to the United States Federal Reserve's increase in the interest rates. All these factors indicate that something is wrong at the global economy. The globalization of the economy has felt the heat of various concomitant factors, which is pushing the central banks of major economies and also India to raise its repo rates and interest rates. Indian policymakers are faced with twin challenges. What are those twin challenges? First challenge is global supply chain disruption. Global supply chain disruption is the impediment of the supplies among the countries, between the countries producing them and the countries consuming them. For example, China is a major producer of many articles needed by the consumer world. When the COVID-19 related disruptions have induced lockdowns in China, the Chinese articles were not exported to other parts of the world, resulting in global disruption. China is always following a zero COVID policy, and for the 6 months it has implemented lockdowns again. Global supply chain disruptions are also caused by the Russia-Ukraine war. With the Russia and Ukraine war, major supplies of energies, that is petroleum and wheat and metals, are affected. Hence, the global economies all over the world are facing a stagflation situation. Stagflation situation in the sense that the prices of all the commodities are rising. And the second challenge which Indian policymakers are facing is that the accurate data related to the macro variable projections are not available. Macro variable projections are like the GDP data. So when the reliable data related to the macro variable projections like GDP are not available, a distorted picture of the GDP is and the growth projection is what is the result. Hence, there are three factors which is responsible for the distortions in macro variable projections because of the inaccurate or the inadequate data which is made available. The first is that from the unorganized sectors, except for agriculture, reliable data is not available. Second, for the organized sector itself, the reliable data is inaccurate. That is, the correct data is not available. And the third is that when the data is becoming available, it is not being correctly put in the perspective. So these three factors are resulting in the distortions in the macroeconomic variables like GDP data. So these twin challenges, one from the global supply chain disruptions and the data related to the macroeconomic variables not correctly available, these twin challenges are just nagging the Indian policymakers. It all started with early 2020 when COVID-19 the pandemic impacted the whole world. And the lockdowns were imposed all over the nations, all over the globe, and all over the world. And thereby the production stopped in countries like China, and the global supply chain disruptions because the Chinese products were not available, were not moving out of the country, resulting in global supply chain disruptions, and it resulted in the prices rising and the stagflation kind of situation. Stagflation is the rise in the prices of the commodities and fall in the consumers' income to consume the products. So this stagflation kind of situation was followed by when the Ukraine war had set in since February 2022. Further supply chain disruptions occurred, and the war is still raging on, and the European and US world is just supporting Ukraine to continue the war with Russia. The economic sanctions are also imposed. Economic sanctions means the stopping of buying materials from Russia. So the energy was not bought from Russia by USA and European countries. So these kinds of sanctions, economic sanctions and supply of war materials to the Ukraine resulted in further supply chain disruptions. China is having a zero COVID policy. Therefore, even if certain samples are detected for COVID, China just imposed the zero COVID policy, that is lockdowns. So again, the Chinese manufacturing stopped, and there was another supply chain disruption. This will lead to, even if the war with Ukraine ends, this will lead to a Cold War situation with some countries on the one block, most of the countries on one block, and China and Russia on the other block. China will depend upon Russia, will support Russia because China is an isolated nation. So this will further compound the problem. The problem is going on getting compounded rather than being solved. And the third main reason why the macroeconomic variables are not accurate, as I said, due to the data inaccuracy or the data inadequate availability. So What is now is happening is that the world economy is moving in a way in which a pilot moves through the fog fog filled climate, clouds, and the environment where the aeroplane which he is driving will have a greater chance of nose diving into the bottom. Friends, and key editorial from the Businessline discusses the discussion paper brought out by Securities Exchange Board of India on unregulated fintech platforms on bonds market. The title of the editorial is Booster Bonds, Bonds Booster. Fintech companies, that is financial technical companies, are those companies those use technical platforms and other related technologies to deal with the financial services. They are doing the stock market intermediary services also, that is the trading in securities, the issuance, facilitating the issuance of securities like the bonds and the debt securities. An example of fintech could be Zerodha, which is dealing with the stock market. There are many fintech companies in India like Paytm. However, for the stock market, Zerodha Securities is the apt example. So these fintech companies are dealing with the stock market securities, even the unregistered securities like the bonds, which are offered to the investors through the online technical platform. So the name fintech. These fintech companies are mostly dealing with the unregistered, that is the unlisted securities, that is private placement of the securities of the bonds, that is debt securities. Private placement is the case in which the securities do not register or list in the stock exchanges. However, the companies privately place their debt securities or bonds to a few selected persons who will invest on those bonds. 98% of the securities, the debt securities traded in the stock exchange are privately placed. Hence, the fintech companies are very attractive because they make the retail investors, that is non-institutional investors, to trade, to place their investment in securities. Recently, during the COVID period, for the last 2 years, the fintech companies have increased manifold. So these people are facilitating the unlisted, that is not listed in stock exchange, securities like bonds through private placement. Mostly the private placement will be chased by institutional investors. The institutional investors are like LIC, the Pension Regulatory Authority funds. These are some institutional investors investing in bonds and securities in the stock exchange. The way in which the non-institutional investors like general public can invest in this privately placed debt securities is the mechanism of fintech companies. Now the Securities Exchange Board of India has come out with a discussion paper on how to regulate these fintech companies which are operating the public investment of debt securities in the privately placed securities, debt securities in the companies. The discussion paper states that the common standard procedures followed by all the market intermediaries should be followed by the fintech companies. And the stock exchange, the most of the transactions should be routed through the stock exchange and the clearing corporation. The SEBI, which is the regulator of stock exchanges and the investor protection, wants the fintech companies should be integrated with the market intermediaries. Market intermediaries are the brokers for short. In simple terms, the brokers are the market intermediaries. So the fintech companies should be integrated with the market intermediaries, and the most of the transactions which are carried out by the online trading platforms of the fintech companies should route through the stock exchanges and the clearing corporations. Then the securities should be, the stock exchange wants that the securities should be routed through the stock exchanges. The SEBI wants the securities should be routed through the stock exchanges and the clearing corporations. What is missed in this aspect is that the stock exchange, the Securities Exchange Board of India requires the fintech companies to regulate only the listed securities. However, the unlisted securities are also very much popular with the fintech companies. Hence, the unlisted securities will cross through the fintech companies and reach the companies through as investment. However, as the discussion paper does not discuss on this aspect, the regulation of these securities will not be possible. The SEBI discussion paper also wants a redressal mechanism to be opened for the investors, because the fintech companies' investment by the public do not have any redressal mechanism if something goes wrong. So a redressal mechanism will be addressed through the SEBI discussion paper on unregulated fintech companies. What is again missed out is that in the SEBI discussion paper, the SEBI discussion paper should focus on the intermediaries making the background information on the securities in their websites and categorizing the securities on the basis of market risks. This information should have been given in the discussion paper, but it's not given. And the next one is that most of the securities, the debt securities and bonds are requires a very huge investment. That is, the investment level is set very high. This is being exploited by the fintech companies which make small chunks of investments, which is very much convenient for the public. However, the discussion paper should have made the level of investments smaller so that the public would have been attracted and the regulation of the fintech companies would have been very much easier. Hence, hope that these changes will also be brought in by the Securities Exchange Board of India in regulation of fintech companies. The regulation of fintech companies is necessary because the public investment is involved, and if anything goes wrong with the investment in this fintech company through the fintech companies, there is no redressal mechanism like the way in which the listed shares and securities investment is enjoying now. Thank you.